This is oil. Well, actually, this is a mixture of black treacle and vegetable glycerin, but it looks like oil. And while the real thing's being thrown around by geopolitical tumult from Iran to Venezuela, you can still buy a lot for comparatively little.
The early days of 2025, oil prices were closer to $80 a barrel.
Since then, there have been slumps and spikes, but still,
an ounce of silver is now worth more than a barrel of oil.
And the price of crude would be even lower if China hadn't soaked some up into its massive reserves. The stuff's cheaper today than it was more than a decade ago, even before adjusting for inflation. Pretty weird in a world ruled by inflation, and it gets weirder still.
We've seen this surprise or shock twist from the OPEC Plus alliance in turning its strategy on its head, from protecting the oil price to opening the taps.
There's a massive oil glut out there at the moment. We're not short of oil.
The irony is that climate risks are accelerating, but the system's finding reasons to produce more oil. Recent developments in Caracas and Kazakhstan are only adding to price volatility in both directions. That's before factoring in tensions between the US and Iran.
One of the biggest changes that we have seen in the global oil landscape over the last 10 years have been that the typical correlation of crisis in the Middle East, higher oil prices, has broken.
So now an urgent question is taking hold. What happens when the oil market's assumptions break down? Let's just get ahead of something here. Many people are disinclined to mourn big oil's difficulties or the budget pain of oil-rich states. But the reality is oil prices shape costs and decisions for all of us.
When we drive, when we fly, when we get on a ship across the ocean, pretty much everything in your pocket, your mobile phone, pens, anything that has a plastic coating on originally came from a barrel of crude oil.
When the price of oil goes up, inflation goes up, and central banks have to intervene, increase interest rates, which can bring unemployment higher, it can destroy value in the equity market.
The oil price matters in part because it's a sign of the functioning of the global economy.
And here's the thing, prices have been on a roller coaster over the past few years.
Brent crude, which is what we call the benchmark for the global oil price, it dropped 18% last year. That's the most since the pandemic.
During the pandemic, what we saw was a true emergency.
A swath of global oil production completely shut down when prices went below zero.
But then, in 2022,
following the war in Ukraine, we had prices rising to $140 a barrel.
And now that hydrocarbon-rich slurry of prehistoric plankton is down around $70 a barrel, a price that's been bolstered by the latest in a string of spikes as traders fret about US pressure on Iran. But when it comes to the broader downward trend in oil price, this time is different. And the reason, which we'll explain shortly, is causing particular concern
for oil-producing economies like Venezuela, Iran or Russia, where the governments rely on revenue from the oil to go into their budgets.
You have OPEC nations who need oil prices well in excess of $100 a barrel to cover their spending plans.
Those are the members of a coalition of producers led by Saudi Arabia. The average forecast from major banks puts oil prices at around or just below $60 a barrel this year. For countries like Saudi Arabia, that's well short of the break-even price their economies need. The discrepancy is even greater for Kazakhstan, Algeria, and Iran.
They're going to get less tax revenue. Then the oil companies, surely, and anyone who works around the oil companies are going to suffer.
And in fact, they already are.
The first wave of cuts that we've seen has been more geared towards non-core businesses. So the companies that have sort of reached out into the power markets, into utility sectors, and reining in some of those investments.
There's precedent for this. In the late 90s, back when TV news footage was annoyingly grainy, oil dropped below $10 a barrel. It prompted companies to even fire the geologists they relied on to find the next big field.
We have not seen that yet, but there is always a risk.
Okay, so why is all this happening?
The drop in oil prices this time is very different to the one we saw in 2020. The driver this time is oil supply.
Guyana is a country which a few years ago didn't produce any oil at all.
And today it produces close to 1 million barrels a day. That makes it a significant global producer. Even Argentina is having its own mini shale boom at the moment.
Other countries like Brazil, Canada, and even the US is pumping at record levels.
A decade ago, the US was unable to export to global markets. Today, it's exporting an enormous amount of oil, sometimes 4 or 5 million barrels a day of crude oil to global markets.
To put this into some context, for 75 years, the US imported as many as 14 million barrels of oil a day to fill a deficit. But America's domestic shale production boom has flipped this to create a surplus. And there it is.
We simply have too many barrels of oil hitting the market, arriving from every corner.
The International Energy Agency estimates that supply is going to outpace demand by about 4 million barrels a day this year, perhaps slightly less. To put it in context, imagine 2 giant supertankers, the biggest types of ship that can carry crude oil, popping up off the coast of the UK or off the coast of Texas in the US every single day for the year. That would lead you by the end of the year to have something like 300 to 700 tankers sitting there doing nothing because they're not needed.
Output from OPEC nations, led by Saudi Arabia and Russia, has also surged.
That started in the first half of last year, sort of accelerated over the course of the year, surprising the market, surprising traders.
It's like, why? Why you will increase output on an oversupply market? And I think that the reason is that they want to regain market share. They are going to compromise for a period, accepting low oil prices in the hope that over time the supply will come down from other sources and that there will be more need for OPEC oil. But that's a big bet, and it's a bet that can be completely derailed if President Trump gets control of the Venezuelan oil and is able to, over time, develop that resource.
And that's a story for the back end of this decade, for 2029 to 2030. Trump himself has been saying that it's going to take a while for Venezuelan oil to meaningfully return to where it was in years past. And there are some in the oil market who think it may never get there, but it's going to take a significant amount of investment to see a major increase to the tune of several 100,000 barrels a day in Venezuelan output, that's for sure.
But here's the thing about those barrels.
We only need the market to perceive that they are coming to that have an impact on the oil price.
Another data point that we look at is what we call oil on the water. So that's a count of the barrels that are either transiting around the world, getting to where they need to be, or else in floating storage. And that tally has increased over the course of last year. Part of that is that oil from sanctioned countries like Russia, Iran, or Venezuela might be finding it a bit more difficult to find buyers.
Let me remind you that oil supply glut is floating in dark fleet ships in places like the South China Sea.
One of the biggest drivers of global oil markets in the last year has been the difference between sanctioned and unsanctioned oil.
Something made all the more significant during the first few weeks of this year, given threats to Iranian, Venezuelan, and Russian supply.
Russia certainly has some difficulties selling its oil as a result of the sanctions and restrictions that we've seen placed on its production.
As sanctions tightened on Russia following its full-scale invasion of Ukraine, a shadow economy emerged, utilizing that so-called dark fleet of aging, uninsured tankers. By repainting names and faking flags, switching off their transponders, these ghost ships vanished from the map.
Initially, there were only a few of these tankers. Today, probably 20 to 25% of the global oil tanker fleet is what we call the dark fleet. Most of the customers of that oil have been in the global south.
They don't really go into the places we normally look at to set global oil prices.
For instance, China, which hoovered up millions of barrels in 2025 into its vast stockpile. Some of that is Russian crude, which the war pushed into the shadows. But if the conflict were to end, it wouldn't stay there forever.
So perhaps the biggest change of a peace deal in Ukraine would be the return of some of those barrels into more transparent, more Western-linked pricing hubs, and that could weigh on oil prices.
The Trafigura Group, which is one of the world's biggest independent traders, a couple of weeks ago came out with a prediction saying that we're at risk of seeing a super glut.
And that matters, because oil prices don't stay confined to trading desks. They seep into our budgets, our travel plans, and whatever's in our back pockets. they shape how much oil the world uses. And while the market can discount a barrel, the climate can't. That cost can be expected to keep rising.